Everyone tells struggling traders the same thing. Control your emotions. That advice is flat wrong. Not because emotions don't matter, because they absolutely do, but because most traders are trying to fix emotions that were created by a broken trading process. You are not revenge trading because you are weak. You are not moving stops because you are undisciplined. You are not hesitating because you lack confidence. Most of the time, your psychology is not the root problem. Your psychology is just the symptom. The real problem is this. You entered a trade with unclear location, unclear invalidation, unclear target, and too much emotional pressure attached to the outcome. And then you blamed your mindset when the trade fell apart. That is why trading psychology is broken. Because most traders are trying to calm themselves down inside trade they should never have taken in the first place. You probably do this right now. You take a trade in the middle of value, price chops around, every tick feels personal. You move your stop, you exit early. Then the trade works without you. So you write in your journal, I need more discipline. But that was not a discipline problem. That was a structure problem. You had no clean location, no clear invalidation, no objective reason to stay in, no reason to trust the trade. So your emotions did exactly what they were supposed to do. They reacted to uncertainty. By the end of this video, I'm going to give you a simple 3-part framework you can use before every trade to tell the difference between a real psychology problem and a broken trade design problem. Because once you understand this, you stop asking, how do I control my emotions? And you start asking the question professional traders actually ask, is this trade structurally worth taking? In the final third of this video, I'll show you how all 3 parts work together in a real futures trade using value, acceptance, rejection, invalidation, and target magnets. And this is the part most traders miss. The best psychology does not come from forcing confidence. It comes from having a trade so clearly designed that you know exactly why you are in, where you are wrong, and what the market needs to do next. That is where discipline becomes easier. Not because you became emotionless, because you became prepared. Part 1. Stop treating emotions like the root problem. Most traders diagnose the wrong issue. They lose money and immediately say, I need better discipline. But slow that down. Was the real problem your discipline? Or did you buy above value after the move was already extended? Did you short directly into a prior low with no confirmation? Did you enter MNQ with a 12-point stop when the actual structure required 35 points? Did you move your stop because you never had a structural invalidation level in the first place? That is the uncomfortable truth most traders refuse to acknowledge. A lot of what traders call bad psychology is just bad trade design. Does this sound familiar to you? You entered randomly, you size too aggressively, you do not know where you are wrong. You do not know where price should go. Then once the trade starts moving against you, your emotions explode. But the emotion is not the disease. The emotion is the alarm. It is telling you, you are exposed without a plan. This is one of the biggest lessons from Dr. Brett Steenbarger's work. Psychology is not separate from performance. Your emotions are shaped by your preparation, your routines, your sizing, your review process, and the quality of the trades you choose to take. A trader with structure will always feel different from a trader without structure, not because one is tougher, because one knows what they are doing. Here's a chart example. Imagine MNQ opens inside yesterday's value. Price is rotating around the POC. Value area high is above and value area low is below. There is no clean directional auction just yet. A retail trader sees the fast green candle near the middle of value and buys. Immediately, price pulls back. Now the trader feels stress. They think, I knew I shouldn't have taken this. Then price ticks lower. They move their stop. Then price rotates back up without them. Now they feel anger. They call it a psychological problem, but look at the chart. They bought in the middle of value, where there was no edge, no clear asymmetry, no structural invalidation, no target magnet with a clean risk-to-reward multiple. That trade was emotionally difficult because it was structurally poor. Now, compare that to a trade taken at VAL after price sweeps below the low, fails to continue, reclaims value, and order flow confirms trapped sellers. That trade feels completely different. Not because the trader suddenly became disciplined, because the trade had structure. The idea is clear. The invalidation is clear. The target is clear. The reason for the entry is clear. That is the first shift. Do not ask, why am I emotional? Instead, you should ask, what about this trade created emotional pressure? Part 2. Replace vague discipline with operational discipline. Just be disciplined is weak advice. It sounds good in theory, but it is useless in the heat of the moment. What does discipline mean at 9:47 a.m. Eastern when MNQ sweeps the prior high, rejects back into the range, delta flips negative, and price is sitting just above yesterday's value high? Should you be aggressive, patient, defensive, flat? The answer depends on the context of the auction. That is why generic mindset advice fails traders. It tells them how they should feel. It does not tell them what to do. Professional trading is not built on feeling calm all the time. It is built on making better decisions under imperfect emotional conditions. You do not need a perfect emotional state. You need a process that still works when your emotions are imperfect. That means your system has to answer specific questions. What is the auction doing? Where is value? Is price accepting or rejecting? Are we in balance or imbalance? Where is the trade location? What confirms the idea? Where is structural invalidation? Where is the target magnet? What conditions tell me not to trade? Once those questions are answered, psychology improves because unnecessary uncertainty decreases. Not all uncertainty. Trading will always be uncertain, but you remove the uncertainty that comes from poor planning. That is operational discipline, not vague discipline. Operational discipline means you have rules you can actually observe. For example, no trades in the middle of balance unless there is a specific failed auction or order flow trigger. No longs above VAH unless acceptance is confirmed, and no shorts below VAL unless sellers are gaining traction. No trade without a structural invalidation point. No target unless there is a logical magnet. No size increase after emotional activation. No second trade immediately after a process violation. No discipline becomes measurable. You either followed the rule or you did not. That gives you something to review. And review is where improvement happens. Here's a chart example. Let's say MES opens above yesterday's value. At first, buyers push higher. Retail traders see price above VAH and assume strength, but then price fails to hold above value. It rejects. It rotates back inside the prior range. Now the trader who only thinks be disciplined has no idea what to do, but the trader with operational discipline has a rule. If price tests above VAH and fails to accept, I do not chase longs. I look for rejection back into value with a target toward POC. That is discipline, not sitting on your hands randomly, not forcing yourself to be patient, not telling yourself to calm down. Discipline is following a defined process when the market creates temptation. Temptation says, buy the breakout. Process says, wait for acceptance. Temptation says, short because price feels high. Process says, wait for rejection. Temptation says, move the stop, give it room. Process says, if structure breaks, the trade is invalid. That is the second shift. Stop trying to become a more disciplined person and start building rules that make discipline observable. Part 3. Build confidence from evidence, not affirmations. A lot of traders try to manufacture confidence. They say things like, I am a disciplined trader. I trust my edge. I am confident. I will succeed. There is nothing wrong with positive language, but in trading, confidence without evidence is fragile. The market will test it immediately. Real confidence comes from evidence. You trust a setup because you have studied it. You trust a level because you understand why it matters. You trust your stop because it is tied to structure. You trust your target because it is based on auction logic. You trust your sizing because it allows you to execute without panic. This is especially important in markets like MNQ. MNQ punishes false confidence. It moves quickly. It rotates aggressively. It exposes weak planning. If you are trading MNQ with oversized risk, vague invalidation, and no clear target, you do not need a better affirmation. You need smaller size and a better model. Real confidence sounds like this. I do not know if this trade will win, but I know why I am entering, where I am wrong, what confirms the idea, where the target is, and what I will do if the market does not accept in my direction. That is professional confidence. It is not prediction. It is preparedness. And this is where self-coaching becomes important. A professional trader does not journal like this. I was emotional today. That is far too vague. A professional trader writes, at 10:12, I entered short inside value after price had already rejected lower. There was no structural asymmetry. I was reacting to a red candle after missing the original move. The correct action was no trade. Now that is useful because now the mistake is specific. And once the mistake is specific, it becomes trainable. Your journal should not just track wins and losses. It should also track setup quality, location quality, confirmation quality, sizing quality, emotional state, rule violations, time of day, auction condition, whether the trade was inside or outside the playbook, whether the exit was based on structure or emotion. Over time, this gives you a map. Maybe you lose money after your first winning trade. Maybe you overtrade after 10:30. Maybe you perform well at extremes but poorly in the middle of value. Maybe your failed auction trades work, but your breakout trades do not. Maybe your biggest losses come after moving stops. Now psychology becomes practical. You stop trying to fix your entire personality. You fix the repeated behaviors that damage your edge. Here's a chart example. Let's say you review 50 screenshots. You notice something uncomfortable. Your best trades happen at value edges. Your worst trades happen in the middle of balance. Every time you trade near VAH or VAL with confirmation, your decisions are cleaner. Every time you trade near POC, you get chopped up, exit early, re-enter, and emotionally spiral. That is not random. That is data. Your emotions are telling you where your edge is the weakest. So the solution is not, I need to be less emotional. The solution is, I need a rule that prevents me from taking low-quality trades inside value unless there is a very specific trigger. That is how confidence is built. Evidence first, confidence second, execution third. Synthesis, how all three work together in a real trade. Now let's put the three parts together. Imagine MNQ is trading near yesterday's value area high. Price pushes above VAH during the New York session. A lot of traders immediately think, breakout, I need to get long. But you do not chase. Instead, you apply the Smart Money Futures trading framework. Part 1. You stop treating your emotions as the main signal. You notice the excitement. You notice the fear of missing out. But instead of obeying it, you just ask, is this a real opportunity or is the market creating emotional pressure? Part 2. You use operational discipline. You ask, is price accepting above value? Are buyers holding the breakout? Is volume building above VAH? Is price making higher lows outside value? Or is price failing to do business higher? Then you see it. Price pushes above VAH, stalls, fails to continue, and drops back inside value. Now the breakout is not confirming. It is rejecting. Your rule says no long above VAH unless acceptance is confirmed. So you avoid the chase. Then price rotates back inside value. Delta weakens. Buyers are trapped above the high. Now a different trade idea appears. Not a long, a rejection trade back toward POC. Part 3. You build confidence from evidence. You know this pattern because you have reviewed it before. Failed acceptance above value often leads to rotation back toward the fairest price. Your entry is not random. Your invalidation is above the failed auction high. Your target is POC or the opposite side of value, depending on the auction structure. Your size is small enough that you can let the trade work. Now compare this to the emotional trader. They bought the breakout. They had no acceptance rule. They placed a random stop. When price comes back inside value, they panicked. Then they reversed their short too late, near the middle of value. Now they are emotional. But they are not emotional because they are weak. They are emotional because they are reacting instead of executing. That is the whole lesson. The best traders are not emotionalists. They are structured. They know what they are looking for. They know what confirms their idea. They know where they are wrong. They know where price should go. And they know when there is no trade. That is real trading psychology. So, is trading psychology broken? The way most traders approach it, yes, because they treat psychology like a separate problem. They try to control emotion without fixing the structure that creates emotional chaos in the first place. The deeper lesson is this: psychology is performance. It is preparation. It is process. It is self-coaching. It is review. It is the ability to execute under uncertainty because your rules are clear before the market pressures you. For auction-based futures traders like smart money futures traders, your psychological edge starts for the trade. It starts with value, acceptance, rejection, balance, imbalance, location, invalidation, target magnets, position sizing, review. When those pieces are clear, discipline becomes far easier. When those pieces are missing, discipline becomes a fight. And in markets like NQ, ES, MNQ, and MES, you do not want to be fighting yourself while the auction is already moving against you. That is why I wrote my book, Trading on the Edge, available on Amazon. Most traders do not need another motivational speech. They need a professional operating model. They need a way to understand value, structure, acceptance, rejection, asymmetry, invalidation, and execution. These free lessons on the channel are designed to teach you those ideas piece by piece. The book is like the textbook. It gives you the full framework in one place. Use my Trading on the Edge book as a professional reference, not a shortcut, not a magic setup, but a decision-making model. Because once your model improves, your psychology has something solid to stand on. So before your next session, do not ask, how do I feel about this trade? Instead, is this trade structurally worth taking? And if you cannot answer that clearly, the best trade is often no trade. Make sure you like the video if it has helped you with your trading psychology. Comment with the word trading psychology if you would like me to make more videos on this topic. Subscribe to the channel if you are serious about leveling up your trading. Thank you for watching, and I will see you in the next video.